All right. So with that, very, very, very excited to introduce our very, very special guest with us tonight. Again, this is a gentleman that we all look up to as a mentor, industry leader, and just all around amazing individual. Gino Barbaro, co-founder of the Jake and Gino community. He's been investing in real estate for 15 years, and along with his partner and his team, has created a portfolio of over 1,200 units. I think that equates to over $100 million of assets under their management. And so in addition to that, they've gone vertically integrated. They have their in-house property management team and such like that. And so Gino comes from a background of chef, if I'm not mistaken, right, Gino? And in the restaurant business for many, many years. 20 years or so. And so before transitioning to multifamily real estate, author, mentor, father of six, which is an absolute full-time job, probably twice over in itself. So, and then with us tonight is his esteemed partner in crime, Mr. Josh Rusin. Gentlemen, how you guys doing?
We are doing good. Do you mind if I share my screen real quick?
Absolutely. Let me give you some permission there. There you go.
First and foremost, as you guys know, having 6 kids, you need to have an amazing partner. My wife is an amazing partner. She homeschools the kids. So I look good. She makes me look great. And it's the same with you all. When you're all partnering with people, choose partners. It's about values-based decision-making. Probably one of the 2 best decisions that I made in my life was to marry my wife. The second was to leave the restaurant. Probably if I go in that order, then obviously the kids. But that was probably the single most best decision that I ever made. And I am proud and to call her my wife. She's an amazing person. And I'm proud and humbled to be on this call tonight because I see how you guys are really kicking ass. Nick, 400 units as a GP. That group is crushing it. Nick, I'm a Luxon. Big shout out. $14 million in deals. And everyone's saying there's no deals out there. I'm going to be talking mindset tonight because remember, behaviors are belief driven. If you believe there's no deals out there, guess what your mind's going to tell you? It's going to prove you right. There are no deals out there. But as you can see, from all the platform, from all the success of the Jake and Gino students, I know right now there's over 18,000 units under contract closed from the Jake and Gino community, over $1 billion in assets closed from the Jake and Gino community. What does that mean? It means proximity is power. That's what that means more than anything else. When you come into the community and when people start looking at multifamily, like Jake and I did, they only thought one way of doing it: buying deals by ourselves. Let me start with a duplex or a quad. And there's nothing wrong with that because that's the way I started years and years ago. Then I started buying deals. And then one thing led to another. And all of a sudden the transition became, let's start buying bigger deals. Let's start refinancing. Never knew what refinancing was. Pulling money out, putting into the next deal. And let's start syndicating. But it's really a journey and a process. I've got Josh here. If you guys have questions as I'm going through, I only have 4 or 5 slides prepared. You can throw questions in the chat box. I'm going to let Josh look at the questions because I can't do 2 things at once. This whole, as they say, trying to do 2 things at once, it don't matter. I have to focus on what I'm doing here. So if you have any questions, please don't stop. Just throw them in the chat box and I'll have Josh read these questions off to me. Let me put this up here. How we doing here, bro? Oh, hold on a second. I'm sorry. Here we go. This is our slogan. We've actually registered, trademarked this. It's education times action equals results. And for me, education was a big part of my journey. When I first started out back in 2008, I actually went to Rich Dad Coaching. I spent the money on that coaching program. It got me into Rochester, New York. It got me into a couple small duplexes, learned how to property manage from afar. And that started my journey. In 2010, got another mentor and same thing, got me into the game. And after that, it really, you need to get your education, but then the bottom line is you need to couple that with action. And if you do one and not the other, you're either going to have your education, as my podcast buddy says, Bill Ham, you're either going to have it on the street or in the classroom. Take your pick. On the street, it's going to be painful and it's going to cost a lot more. And as you can see from the results from a lot of the gentlemen on this call tonight, they've taken their education to the next level, but it's not just education. They've taken some massive action along with that. These are the 4 books that we have out right now. Bill Ham is our coach. We just launched Creative Cash. That is a book on seller financing. We are hoping that the debt markets are going to, close up a little bit, seize up a little bit. We do some creative financing. It hasn't happened yet, but it will happen. Markets do cycle, everybody. Have podcasts. So if you haven't checked out our podcast, we have the Wheelbarrow Profits podcast. We've created a brand called the 100-Year Real Estate Investor. And to me, this is really a passion project for the next couple of years. You know, I'm looking to really scale this company. But the real genesis behind this, and what I've noticed in my life, is whenever you take the view, the long-term view, and it's hard because we're all in this instant gratification world. I'm trying to teach this to my kids more than anything else. When we're looking at transactions and just flipping and just buying a home and flipping, that's great, but it doesn't build wealth. It doesn't build security. It doesn't build equity. You need to look at the long term. And that's why multifamily is great and it stinks at the same time, because you really have to figure out yourself, how am I going to get into this business and look at it long term? You need to put deals, as we say, on that conveyor belt. Start putting deals on that conveyor belt. And it may take 12 months or 18 months to get your first deal. It took Jake and myself 18 months to get that first deal. But after that first deal, I'm sure a lot of the guys out here can attest, that second deal comes pretty quick. And it's strange how that happens. You're working so hard, and then all of a sudden, the brokers see that you've closed the deal. Your family and friends come around and go, hey, Cody, what are you doing? Nick, what are you involved in? Doing multifamily. Would you like to learn more about it? And then all of a sudden you've got more investors. And that's the powerful thing with multifamily, sticking in there and working through it. These are the rest of the shows that we have. A lot of the students have been on our Movers and Shakers show. If you want something, a little different flavor, Multifamily Zone, my wife and I, we do a podcast on spousal relationships and communication. And what I love about this show more than anything else, I've been doing this for about 2 years. She likes to do the family and the spousal communications and the life coaching. And I always have to throw business in there because I'm amazed at how business and family are so intertwined. To have an amazing business, you really have to treat it as if you're having an amazing family. You need to have core values in there. You need to have great communication. You need to have a big why. And you need to be obsessed with having a great family and with having a great business. So if you haven't heard of or seen the Multifamily Zone, please check it out. This is the picture we had. Josh, where was this picture?
So this is Knoxville, Tennessee, on site at one of our properties, actually at a student event.
This was the Money Mixer. I think we had the Money Mixer back in April, about 150 students. We had 3 buses out there. I can see right in front, Chris Jackson over here. I mean, a lot of it was just an awesome day. This is really what I'm going to touch on, everyone, tonight, mindset. And for me, this changed everything. You know, I wish we had a chat box. You know, by a show of hands, how many, just put in the chat box, how many of you read the book, Carol Dweck, Mindset? Put it down there. Say yes, no. Let me know what you think about it. So Brian, it's on your to-do list. That's the next book you've got to read. I'm sorry, you got to put it up on the queue. And the reason why, take a look at it, everybody. We podcasted Eduardo Brasinas. He was Carol Dweck's case study when she wrote the book. And the thing about mindset, and what I love about the book, and I never really thought about it intuitively, they break it down into 2 types of mindsets. Let me tell you, the first one is the fixed mindset, and the second one is the growth mindset. And what's amazing about these mindsets, you can change them if you want. You have the ability, you have the conscious ability to change them. Now, the fixed mindset, a lot of that's going on right now in society. We're putting the blame on others. We're not taking responsibility. I can give you a lot of examples. One of my favorite tennis players growing up a long time ago was John McEnroe. That's the fixed mindset right there. Now, what does that mean? Why did he have a fixed mindset? He was amazing. Anybody remember John McEnroe, how amazing he was? But man, was he an asshole, huh? It was always somebody else's fault, whether it was the weather, whether he was hurt, whether, whether his sawdust, not enough sawdust in the tennis racket, whether it was too loud, whether it was the ref's fault. That's the fixed mindset. Do you want to have that mindset? The problem with the fixed mindset is there's no growth there. You're fixed. And when I, teach my kids and I'm with my children, I don't want them to adopt a fixed mindset because it seems as if you have to be perfect. You can't make those mistakes. What I love about the growth mindset is what I want my children to adopt, and what I've adopted. I've had to have that growth mindset because I look back and I go back listening to my first and second and third and 20th and 50th and 100th podcast. They were pretty terrible. I mean, they really were. And if I had the fixed mindset, I probably would have quit and said, you know what, I'm not getting any better. But I adopted that growth mindset with that and with every business that I've done, because from day one, it's all about growth. It's all about learning, and it's all about working hard and working better. And that's what I love about the fixed mindset, because you're there and you want to teach your kids, you know what? You didn't win first place. That's fine. That person who won first place deserved to win first place. You won third place. If you're in third place and you want to become first place, all you need to do is work harder. You really need to commit and dedicate yourself and work hard. And that's the message that I want to give my children. And that's the message that I want to leave with all of you tonight. Having that growth mindset, it's okay if we make mistakes. It's okay if we don't win. I think the biggest thing in life is to try to get better, every single day, and try to come with the passion that you want to succeed in whatever endeavor that is. And for me, multifamily has been that way. I mean, like I told you, it took me 18 months to find that first deal with Jake. And that first deal was hard. And then it took another 6 months and then another 6 months. And we've been scaling and growing and making mistakes. And for me, I was in that restaurant for 20 plus years. And it was hard in that restaurant. And I had that fixed mindset back then. How do you explain, Cody and Nick, for myself? I had one restaurant for 20 years, and within 5 years, I've got 1,500 apartment units. You're looking at it on the screen right there. It's all about mindset. It's all about finding an amazing partner. For me, Jake was my savior. You know, I rank him up there with Julia, to be honest with you, because he saved me from the restaurant. I'm sure that I helped him out on the journey as well. But I look at him as a mentor. I looked at him as somebody who worked really hard, and he just really pulled me out of what I was doing. And he lifted me up, man. He helped me out. And then from there, having that amazing partner, having that amazing accountability allowed me to make those mistakes, allowed me to say, hey, you know what? Let's write a book. The first book wasn't that great. The second one was a little bit better. This third one's even better. But if I had that fixed mindset, I probably would have quit after the first book because it didn't do as well. I only did sell thousands of copies, but that's what the mindset's all about. Adopt that growth mindset. And I challenge everybody on this call, please. Next book you need to read is Mindset by Carol Dweck. And I'll give you another recommendation that really completely changed my life over the last 6 months. The 7 Habits by Dr. Stephen Covey. Amazing book. If anyone has read that book, put it in the chat box, because that book with those habits, I read it 15 years ago. I just wasn't ready to read it. It was not there for me. But those 7 habits, if you can adopt those 7 habits, and that's why it's important with multifamily. His second habit is, think with the end in mind. What do you want your life to look like when your life is over, at your funeral? And that really impacted me. And for me, that's why I'm inspired to do Jake and Gino, because I want my kids around my deathbed saying, Dad was really cool. He impacted a lot of lives. It wasn't just about money. It was about doing something that he was proud about. And that's how I live my life. I reverse engineered that. And how does that look? That looks like, you need to get on these calls. You need to continue to grow the Jake and Gino community. Don't worry about monetizing all the time. Give back, right? We're always saying to ourselves, oh, I'm going to give back. I'm going to become, donations when I have the money, when I have the time. No, start right now, because you will grow into that. So for me, that book totally impacted my life and totally changed the trajectory of where it was going. It wasn't just about me. To me, that it really made me really expand the community and think about how can I bring multifamily to other people. And, adopting that scarcity mindset versus the abundance mindset. I lived in that scarcity mindset years ago. And when I ultimately found the abundance mindset, it was amazing, because people are saying to me, Gino, why do you want to share this information? You have students taking deals away from you, closing deals away from you. And I say, maybe, probably, but that's okay, because I have other opportunities coming my way. Students want to partner with us. Students are raising capital from our platform. And I'm learning every week and every month from the student base as well. When we have these boot camps that we're having a boot camp when August 14th and 15th, the next 2 to 3 weeks, we're having 50 to 60 students there. I'm learning from them. So you can look at it, life any way it is. People see the world as they are, not as it is. And I was seeing the world as I was, from that scarcity mindset. And that abundance mindset completely changed my life. And that's why I'm here preaching those 2 books, that mindset book and the Stephen Covey book. Josh, anything to add on that?
I'll give you a good acronym. It's called FAIL. So FAIL stands for first attempt in learning. So anytime you're new at something, just know that's normal.
First attempt in learning. I'm writing that down. Now I've got this. I think this is probably the last slide that I have. That I want to jump into questions, but I can go on for a while about this slide. We trademarked this. This was Bill Ham's thought process. We have the 3 pillars of real estate. We have the buy right, manage right, and finance right. But the reason why I want to talk about the 3 pillars of real estate for everybody out there getting into it, it's a risky time to get into the market if you don't know what you're doing. You really need to know what type of assets you're buying in this part of the market cycle. And the 3 pillars of real estate, I want everyone to write this down. The first one is the market cycle. The second one is the debt. And the third one is the exit strategy. So market cycle, debt, and exit strategy. When I first started buying deals, I didn't even know what the hell an exit strategy was. I'm going to say I'm going to buy and hold forever. Was that a good strategy? Maybe, maybe not. But now every time I look at a deal or I even look at a business, I mean, we just podcasted a lady named Michelle Seiler Tucker. She wrote a book called Exit Rich. Every time an entrepreneur starts a business, their mindset is, I'm going to start a business. How am I going to exit this business and get into another business? And this is what you should do every time you are underwriting a multifamily deal, whether it's a fix and flip, whether it's a buy and hold, whether it's self-storage, whatever it is. What is your exit? Because you need to know what to do with this property. Are you going to hold this forever? There's nothing wrong with that. Are you going to refi this deal? Are you going to flip this deal? Always think of your exit strategy. It is crucial for you to do that. The second component is that market cycle. And, me and Bill have been tossing the idea around markets do cycle, but do markets cycle or do people cycle? And that was a really big eye-opening, thought that he threw out there the other day. We're going to be talking about that at our boot camp in August, because he talks about market cycles. And what do we mean by that? 5 years ago, the market was 20% IRR and, 8 to 10 pref. That's where the market was. And all of a sudden, where are we now? Maybe 12, 14 IRR. Are people cycling or is the market cycling? Are we just succumbing to the fact that maybe multifamily is going to have less cash flow going forward and more cap appreciation? No, I'm not sure. But I know in this part of the market cycle, what we are looking at buying right now, we're looking at buying assets that are a little bit newer. We don't mind buying older assets. We have older assets. The problem with the older assets is if the C property is trading between a 4 and a 5 cap and you can buy a B property at 4 cap, why not buy the newer property? It's just that simple. We're looking for vintages at least mid 80s and above built. We're looking for assets that are in good areas. I mean, no other median income is in the area. We're looking for garden style apartments. We like to have brick. Figure out what your buy right criteria is. Everyone's criteria is different. And as entrepreneurs and as business owners, when you can make a decision quickly, man, game over. When you can say yes to something, game over. And more importantly, when you can say no to something, get rid of that opportunity because it's not an opportunity anymore and go focus on the next one. So what I want everyone to do tonight is think about what your buy right criteria, and it's different for everybody. If you're a younger individual, you may say to yourself, I don't really need cash flow as much, so I'm going to underwrite a deal for more of cap appreciation. You may be a little bit older and want to look for deals that produce a little bit more yield because this is your retirement. That's great. It's all individual. Look within, look with what you need, and especially what market are you in? All these markets are different. Cap rates are different. Returns are different in every market. So understand what your buy right criteria is. That's the first thing with the market cycle. We're looking for those assets. Now, the debt. Let's put all three of these together. Because you're looking at market cycle, you're looking at the exit strategy. Whatever your exit strategy will tell you whatever debt you're trying to get. If you're trying to hold fixed rate long term, maybe you're going to go with agency debt where there's a yield maintenance and you're going to hold this bad boy long term. If you're going to flip it out in 2 to 3 years, maybe you go with a community bank or you go bridge financing. Or what about this? What about using seller financing? That's another debt component. You see how all three of them work really, really well together. So if you know what part of the market cycle you're buying in, we know what we're buying. 4 to 5 caps, B to C properties, a little bit newer, hopefully 7 to 9% cash on cash return once this thing is stabilized with IO. And then once the deal goes to principal and IO, it can continue to cash flow. That's what our criteria is. We've passed on a lot of deals in the last 12 months, but that's okay. Because remember, once you buy a deal, that plane, as Bill says, is in the air. That's it, game over. You've got to land the plane sooner or later. So there's risk in buying a deal, which is fine. So that's why we're really sure on the type of deals that we're buying. So remember, market cycle, debt, and exit strategy. Want to add anything to that?
No, I think one thing that, although it's not on the fundamentals, is I think your direction is more important than your speed. So like he said, when he first got started, he was taking those steps, but he may have not had the speed he wanted, but he stuck with it and picked up speed.
So for me, it's also, bringing in the buy right, the manage right, and the finance right. It's really important. Those three components, break it down into that. You have the 3 pillars right here, but when you're looking at a multifamily deal, it really comes down to buying the asset right. So you have your criteria, financing it right. Learn all the different finance strategies there are. You have, like I said, agency, you have community, you have bridge, and then the manage right portion. The manage right is what we excel at, Jake and Gino. We're vertically integrated. We have great coaches on staff that will help. I mean, there's property management and there's asset management. So when you're looking at a deal, separate the both because they are two different components. As asset managers, you are there looking at the asset and you're trying to get a return for your investors. The property managers, their job is to put butts in seats. They don't really care as much about budgets. Those two are going to conflict. So make sure those are separated. So make sure buy right, manage right, finance right. And then you have those three pillars working in conjunction. Cody, open it up. Let me have some questions here because I can continue to keep talking about this all day. I think the last thing I would say about the deals we're looking at right now, there's two types of deals that we're really looking at right now. We're looking at deal type A, like we like to say, that more stable kind of deal, right? 7 to 9% cash on cash return. It's more of a momentum play. We're looking at more stable asset. And deal type B, it's a heavier lift. It's you're going in there. There really is no cap rate. I mean, you can't really underwrite this deal. We know we're buying it at a number. We know we've got to put some type of CapEx into it. And then there's a return on the back end. There's no cash flow. There's more risk on that deal. I wouldn't, tell people to do this if it was your first or second deal. We can do 1 or 2 deals of those a year because right now it'll stress our CapEx team because right now it's very difficult to find maintenance guys. And if you're buying a lot of those heavy lifts, they may look great on paper, but it is difficult to find help right now. So we're doing 1 to 2 of those a year tops. We like those momentum plays. So those are the two types of deals we're looking at, that momentum or that heavy lift.
Yeah, I love that, Gino. That's great. I do have a question for you, and I don't want to assume anybody on here is, new or whatever their experience level is, but, you mentioned that there may be a higher degree of risk entering into the multifamily space in this market at this point in the market cycle. It's also becoming more challenging for those who are a little less experienced. What advice would you give to those who may be just coming into the space, let's say over the last 12, 24 months, and how to break through some of those barriers right now?
They say hindsight is 2020. And when I got into it in 2010, 2011, we have such short memories. The market, the economy sucked. GDP was 1%. Rents for a 1-bedroom were $300. I mean, there was a recession going on. There was no money to do deals. There was no syndication. To me, that was a lot of risk. Now looking back at it, I was just stupid. I was just desperate. So at that time, I was ready to get in. When you're ready to get in, that's when you need to get in because it's not going to happen overnight. So I got into 2010, 2011 with Jake, and it did take me 18 months to get that first deal. And when we bought that first deal, there was a significant amount of risk looking back then. Getting into it now, right now, there's so many opportunities to get into it. You need to get into it long-term. This is an amazing asset. When we got into COVID last year, everyone was going to say multifamily is going to crumble. Rents are going away. You're not going to make collections. April came, we collected. May came, we collected. June came, we collected. I mean, rents in Knoxville are probably going to go up 10% this year, believe it or not, when people were telling us rents weren't going anywhere. Now it's all market specific. You have to know your market. You've got to pick a really good, strong market. I mean, if you're in California, New York, be careful. I mean, people are fleeing those areas. Costs are really expensive. Rents, if they don't go up, if they're flat, we're basing our analysis on NOI and rent growth. So if that's not happening, what's going to happen? Prices are probably going to stay flat. I don't know what's going to happen in those markets, but just select markets that are where people are moving to, where there are jobs and where there's rent growth. And you can find that out pretty easily. I mean, you look at all the markets that have low cap rates. As investors, people shun lower cap rates. Lower cap rates just denote a couple of things. There's less risk in a lower cap rate market. You're paying more and you're more likely to collect that rent going forward. I mean, I'm not going to bash Cleveland. I like to tease Cleveland a little bit, but there's a reason why Cleveland's got a 9 and 10 cap as opposed to Nashville. It's got a 4 cap. People are leaving Cleveland. I mean, there's population loss. There's 1 or 2 major employers. People are moving to Nashville. Rent growth is growing in Nashville. There's a complete difference. So there's less risk in Nashville. That's why investors will pay more. And when you're buying something at a lower cap rate, adding value, you're getting a much bigger bang for your buck when you're doing that. Now, if Cleveland was my backyard, I'd be all over. I'd be investing in it every day of the week. I'm just saying, if you're out of market, and let's say you live in California, if you're going to invest between one of those two markets, I would go with the national market. I would go with the higher growth market for that less risk. And for your question, to come full circle with your question, to getting into it right now, there are so many platforms. Start by listening to podcasts, start by reading books. But ultimately, if you're serious about the endeavor, you need to go out and you need to join a community. And why do I say that? Every single thing I've done in the last 5 to 10 years, I've done with coaching. I started taking singing lessons 3 weeks ago, right? I'm doing some opera because I really want to work on my voice and my public speaking. And I'm going to tell you, I suck at singing. I thought I did. And in 3 weeks, I've learned more in those 3 lessons than I would have learned by watching any YouTube videos. And it's amazing. I have somebody who is a 40-year opera singer. His name is George, a big Russian dude, got a baritone voice. He's great. He can teach me. So that's just one aspect of it. Next aspect of it, when we started scaling our company, we never knew how to scale a company, let alone a real estate company. We hired scaling up. We spent like 50 grand on that in a year and a half. Best 50,000 ever. I never knew what a net promoter score was. I'm sorry. I never scaled a business. I never knew what a cadence of accountability was, having quarterly priorities, having daily huddles, all this stuff. I never would have learned. And if I would have learned, I would have taken years and years and years, and I wouldn't have been able to scale up. I wouldn't have been able to retain the type of talent that I have right next to me. It would not have been possible. I mean, the list can go on and on of all the things. We're actually shooting guns tomorrow, right? We've hired a trainer because I want to learn how to shoot a gun properly. I want to do it safely. Right? I'm not really good at it. So I'm doing that. I'm spending money to do that. So for me, I call it spending, but I'm investing in myself because I want to learn from the best. And I really want to become responsible and I want to get good at it. And I don't want to waste my time doing it by myself and watching YouTube videos. So for me, mentorship and coaching has gotten me to where I am. And it's going to continue to get me where I am. That I practice what I preach. I love investing in myself. That's the best ROI that I could possibly have. And it will take me forever. Once I learn a skill, it is learned. On to the next skill. So how do I do that? I find people who are successful, and success leaves clues. You want to add anything to that?
Gino, I think you hit the nail on the head. If I were to start over, and exactly what I did is find someone that had the results that I wanted, and I found a way to add value to them, right? So a lot of times that becomes seek to serve or pay to play. So came here, worked for these guys, and really saw what successful people are doing. So always be reaching up. Success leaves clues. I think rip off and duplicate it is a good way to look at it, right? In business, they call it smart, but in school, they call it cheating.
And Cody, the other thing is Josh came here. He had a lot of value. He had a skill that we needed, right? And that's the great thing. So everyone on this call, find what value you have. We all have tremendous value. Find what we're good at. Are you good at raising capital? Are you good at managing a property? Are you good at managing systems? Whatever that looks like, try to find that skill and try to find somebody who doesn't have that skill. Partner up, bring that skill to somebody, because multifamily is all about team sports. I mean, I could not be on this call if I didn't have Jake as my partner, because he's running the property management day to day. I'm doing the education day to day, and our day just blends in like that, because when I'm learning here, I transfer over to the property management and vice versa. So, for me, it's really continuing to grow, continuing to work, and continuing to educate yourself, because there's always something new to learn. Does that answer your question?
Absolutely, man. It was awesome advice. I appreciate it. And by the way, you got to have to give us a preview of those vocal lessons that you're taking.
Oh, I expect to see that at the next one.
Before we get off, I'll get you a little Santa Lucia. Don't worry. I'll hit that up for you.
Sounds good. Josh, you got a question there. You want to narrate those, or you want me?
Yes, I got it. So if multifamily is going towards an era where you can bank on appreciation, but not much cash flow, is it any longer an asset to pursue for new folks who are looking for cash flow?
That's a great question. I mean, if you're looking for cash flow, there's so many benefits with multifamily, right? There's tax benefits. That's one of the reasons why people are investing in it. What other asset can bring you cash flow? If you're comparing it to stocks that are distributing a yield, I'm still worried about stocks. I'm still worried about that whole bubble that's going on over there. To me, that's one of the biggest Ponzi schemes ever. I don't trust companies. I don't trust their earnings. So for me, I love multifamily. I can touch it. I'm managing it myself. I know long-term it's a hard asset. I know they're not going to stop printing money. When there's $4 trillion in EIDL and PPP that haven't even trickled into the economy. We're actually podcasting a gentleman named Peter Linneman. He wrote the book, the Commercial Real Estate book. He's an amazing economist. And I was listening to one of his podcasts, and he made an analogy. If you've got $4 trillion and you give that money to Beavis and Butthead, what are they going to spend money on? They're going to go buy AC/DC shirts and all that kind of crap, right? So now the government's printed all this money. And who's it giving it to? They've given it to banks. And what are the banks going to do? They're going to lend it to assets into multifamily. What's going to happen to that? It's just going to elevate the prices on that. So maybe we don't focus as much on cash flow. Maybe that's the new paradigm. But for us, we're still going to look for that type of cash flow. We're still going to underwrite deals and look for the pro forma, because we're always buying deals on pro formas. They're just buying them on our pro formas. And we have to be careful with rent growth. And that's the tricky part. That's what's really tricky in the next 12 to 18 months. Are we going to achieve those rent growths? From what I'm seeing, single family housing is not there. People are continuing to rent. There's still a lot of money out there. So single family homes are being bid up. The only thing that's keeping the asset valuations up right now are really low interest rates. And I don't see interest rates going any higher right now, because we have a debt problem here in this country. But no one realizes, not many people, that the emerging markets overseas have a bigger debt problem than we do. If rates go up, they're pretty much screwed. And then the rest of the world is completely done, and money is going to continue to flow here. So that's one thing that we have to think about. It's not just what's going on in this country, it's going on everywhere else. And that money is continuing to flow here as what they think is a safe haven. So for us, just continue to buy these assets, holding these assets, performing with them, having those tax benefits, running it like a business. And we're still producing yield with these, maybe not 15 or 20% cash on cash returns, but we're still getting 7 to 10 on a lot of our deals. And once they're repositioned, and once we have that rent growth in the next 12 to 24 months, we will hit our numbers. And we have been hitting our numbers. Does that answer the question?
Yeah. Thank you. Thanks, Jake.
What else you got for me?
What advice would you have for investors looking to choose a property manager?
I've got a questionnaire. If you want to hit me up, email me, Gino at jakeandgino.com. I can give you a questionnaire of what you should ask property managers. First thing is, for us, when you're hiring a property management company, they are the face of your property. The first thing that when they walk in, they're looking at your property manager, sit in that chair. What are their core values? Ask what their core values are and what their mission statement. If they look at you like deer in the headlights, that may not be the right company for you. The second thing is, I would ask what kind of properties they're already property managing, and maybe you do some secret shopping. Call those properties up, see how they answer the phone. Is it to your liking? The next thing is, what kind of cadence of accountability do they have? Are they getting on every week with me? Are they telling me what's going on? Are they being proactive? What kind of associations are they doing? How are they investing in training with their employees? All these things are so important, because they are the face of your company. Obviously, you want to know what the costs are. You want to know what the property management fees, but that's where everyone goes to. We all go to price. And this guy over here goes to price more than anybody else. But remember, we need to go to value. And what value are they bringing? Because they're going to be one of the most important partners in this entire game. And if you've got to give another point or two on the front end, not the end of the world if they're bringing a tremendous value to you. For me, when you hire the property management company, please make it a weekly cadence of accountability that they need to get on every week with you. We send out a weekly pulse from our property managers, and every week we know what our vacant rented are, our vacant unrented. We know what our delinquencies are. We know what applications are going in every property. We know what income and expenses are. You want to know that. You want a property management company that's proactive. You don't want to find out in week 3 that you have a 20% delinquency problem and economic occupancy is at 74%. You want to know that the week 1, week 2, what's going on. So please have a property management company that's accountable. And like I said, I'll send out that list to you, because there's a bunch of questions, a bunch of things that you can verify and and check them out. But for you, set up core values for yourself, because for us at Jake and Gino, our core values are people first, make it happen, extreme ownership, unwavering ethics, and growth mindset. Those are our 5 core values. If I'm going to hire a property management company, if they don't have those same core values, or if I'm going to hire a landscaper and they don't have those core values out, I don't know if anybody came to our boot camp last year in July. We pull up with a bus load of students. We get out at one of the properties, and I see Jake. He's pissed off. Like, what's going on? And he's like, the landscapers didn't show up. They didn't cut the grass. Didn't look good. He was so pissed. He's like, you know what? These guys are fired. Done. And they didn't show up. They dropped the ball. And that's what core values are all about. When you hear an employee say it's not my job, but meanwhile, I'm packing books, and that employee is going to tell me it's not my job. Well, they're not part of the company. That's just the way it is. If they can't live our core values, obviously we need to live our core values. But if they can't live our core values, they're not going to be part of the team. And that goes the same with vendors. And I struggled with that for years. That's why I had one restaurant. I didn't have core values. It was always the employee's fault, right? But how can it be the employee's fault if I'm not giving them direction, if I'm not telling them what to do, if they don't have a leader? So all those years I was complaining, but I wasn't looking in the mirror, and it wasn't really my fault. It was because I didn't have the skills. I didn't know about this stuff. So it was really upon me. It was my mistake, but I didn't know. Once we started scaling these companies up and I invested with scaling up, I'm like, wow, the first thing we worked on was our core values and our mission statement. Once you have a clear mission statement and clear core values, sky's the limit. Gives you clarity. It's all about values-based decision making. Have a set of values. If you don't have a set of values, how are you going to make decisions, everybody?
Okay, so we have a question from Dustin. What is your formula for calculating operating costs when underwriting a property before submitting an LOI?
What is your formula for calculating operating cost when underwriting a property before submitting? So operating costs, as far as you're talking about, if there's a rule of thumb is in, for let's say 50%, when you're operating a property, that's why you really need to know the market. We just underwrote a deal in Knoxville. It's $6,000 per unit. We know that that's what it is in there. Every market is completely different. You can't go by a rule of thumb where it's a 50% rule, because let's say the property is doing 10 grand a month in revenue. Okay, expenses are 5 grand, but it's a mom and pop and it should be doing 20 grand a month. Well, if you do the 10% rule, then it should be 10 grand. You need to get granular in your market. That's why it's really important to understand your market, understand what expenses are, because property taxes are different in Dallas than they are in Tallahassee, Florida. Labor's different. Utilities are different. Utilities are different from one part of the city to the next part of the city. So you really need to understand what your expenses are. I know in Knoxville, for a property that's 75 units and above, it's about $5,000 a door per unit per year to run that property. Those are the operating expenses. Capital expenses are different. CapEx is below the NOI. Operating expenses, anything to run a property, whether it's landscaping, contract services, repairs and maintenance, management, taxes, insurance, all of that. So know what the expenses are to run a property. And that's one of the biggest mistakes that beginning investors come on. They come out and they don't underwrite the deal with proper expenses. And the problem is with a lot of these mom and pops, 30, 40 units, they don't have expenses. They don't have a management fee built in. They cut the grass themselves, right? Their insurance is really super low. Their contract services are negligent because they're plowing their own driveways. So know what those expenses are. That's the only way to do it, is to find out what the expenses are. And that's what a good property management company will do. If you have that relationship, you can call them up and say, hey, what does it cost to run a 25-unit property? They'll tell you, because they're running those properties in the market, and they'll let you know what utility costs generally run for a property, what garbage typically runs, all those different expenses. So know your market implicitly well.
All right, serious question. Who makes a better pie, Marco or Gino, and why?
Ooh.
So my brother makes a better pizza because he works up front, but I don't tell him. I'm a better cook than him. I mean, he's in his dreamland with making
Marco's right here.
Yeah.
So I had Brian Alfaro in New York this weekend. So I think I made a pizza at Gino's, Gino. So I think I beat you, bro.
Dude, bring the pizza on, bro. I mean, the pizza is a great thing, but you make money with the food. That's all I gotta say.
So Gino, I want to say one thing. I want to talk about what you taught me, everything growing up and at the restaurant about mindset. Is in 2016 I was stuck, and I went to you, and I was doing great with the properties, investing with you and Jake, and I asked you a question. I want to get out of the restaurant, and you told me what do I want, and I said I want to leave. So I thought about it, and it was all about coaching. And what you talked about, investing in yourself. So I did 2 things. I went to Tony Robbins, and I also did the Jake and Gino platform 2 times, the whole coach. And I got coaching from Jake and Gino. And that's really what's got me to where I am today. So, I just want to give a shout out to you, man, for that.
I muted myself because I was thinking about that for a second. And I don't want to, tell anybody. I really should share this with everybody. I actually got life coached, and for me, life coaching was transformational. And when everyone think about life coaching, they think about foo-foo, but for me, I really needed clarity because I didn't lack the motivation. I lacked the clarity of what I wanted earlier on. When my dad passed away in 2007 from the restaurant, it was hard because I'd worked with him for 30 years of my life. I mean, I was 8 years old going to work for 30 years. He passes away, and I'm like sitting in the kitchen. I'm like, I don't want to do this anymore. And even more importantly, I'm like, am I living his dream or am I living my dream? And I was at crossroads at that time, and it was really hard. And I needed clarity. I wanted to know what my next step was. I didn't like what I was doing. And I said, what do I want to do? I have to figure out what my why is. And my why really was to build a business, to really build something that I would be proud of. I didn't want to go to work every day with my kids see me come home pissed off and tired. We all work hard. I didn't want them seeing that. I didn't want them to relate and to connect hard work with being tired and being angry. I want to find something that I love to do. And that's what I'm doing right now. I came home tonight, jumped on here. They know I'm excited to do this. And that's what I wanted to do. So for coaching really gave me that clarity. And it's a safe space. I had a coach. I went through the program. I became certified as a life coach. That's not what I wanted. I always wanted the personal development aspect of it, but being able to ask those tough questions, why real estate? And then when you figure out your why, we're always going to find a way how to do it. It always comes back to that because times are tough. There's no deals right now, right? So you'll find a way. We'll keep plugging away. I'll figure out how to do it through my why. And for me, life coaching was completely transformational. It changed my life. And I was able to relate. I learned a lot of skills, how to ask questions. Believe it or not, become a better negotiator, becoming more empathetic. There's a lot of empathy going on when you're dealing with people and you're talking to people. It's easy to judge people, right? And really don't want to do that. You want to be empathetic toward what their situation, what they're going on. And when you have the empathy towards somebody, you really grow and you really learn. And for me, it was transformational. I'm just so happy that part of my life, I was able to do it, able to grow. And it's really made me be able to connect with other people because I'm just there. And I love to listen to people's stories. I love to listen to what they're all about. We all have this amazing ability. God put us on this planet to be amazing, to do great things. And sometimes we get stuck in the rut of thinking about going to work and paying the bills. Man, I used to chase money all the time. And I thought when I became financially free that, oh, game over, dude, I'm going to retire, go on the beach. That was the last thing I thought of when I came down here. And instead, I doubled down. I hired this guy and we just started doing Jake and Gino. And now I'm not really chasing money anymore. I'm chasing opportunity. And that's where you want to be in life, not worrying about making money, but worry about creating opportunity. And ultimately, I just want to be a financial steward to my family. And I just want to be a steward and I want to leave a legacy because we're not here forever. And I want to just leave an imprint in this life. And that's what my why is. That's what drives me to be a better person and to grow and to continue with this Jake and Gino community because the education space is not easy. I mean, it's a 24/7 kind of thing. I have students, I need to get to them because I'm their fiduciary. If they have a question, Josh will tell you, I'm there at 10 o'clock at night, typing in the answer on the computer. My wife might think I'm crazy. People might think that's work. I love that. I'm actually helping somebody. I'm helping somebody progress through their lives and helping them find out what their why is and figure out how to do it. So for me, that's why I love what I'm doing. And I'm just trying to figure out how to show people how to get to that space in their life where it's, you know what, we're going to struggle with W-2s. We're going to struggle, but that's not the end all be all. We're just built to do so much better things in life. And I think if we can focus on that, all these little things that come up and pop up in our lives, we can solve them.
Gino, one thing I really learned from you was I remember I was about 24 years old and you had a coach for the restaurant and you were paying for it. And I asked you one day, I didn't really understand coaching. And I was like, I can't believe you're spending money on that, like for the restaurant. But it worked. It really helped us there and helped change my mindset that I needed that for everything else in my life.
Well, the cool thing about that experience was it was a lot of money at the time. I was like, dude, how much? But I look back at it, I was trying to write a cookbook. I'd never written a cookbook before. And you know what he said to me? The stupidest advice ever, but the best advice. He says, write 1 page a day. At the end of the year, you have a cookbook. I was too stupid even to think of that. But somebody told me that one little bit of advice. I'm like, I can write 1 page a day. I can do 1 recipe a day. At the end of 6 months, I'll have a book. And that one conversation with him and give me that clarity changed everything. And I ended up writing a cookbook. So it's, you know, where you are in your journey, where you're just I was just sick and tired of doing that. And that's what ended up happening, Marco. You know what? I know that I want to do something. I just don't know how to get there. And, you know, Jim Riley at the time was a big help.
Guys, the awesome partnership that me and my brother have is he was spending all this money for me and him. And I like felt guilty. I was his younger brother. And I said, you know, do I owe you money? And then he's like, no. So I said, good, I'm not going to give it to you anyway. So it's okay. But he, it's all about the mindset that I learned from him and everything I needed,
So I got a question from Josh Obregon. Brother, haven't seen you in a while. How you doing? For your heavy lifting plays, have you expanded into tertiary markets and beyond in search of cash flow? If so, how are you defining a tertiary market? That's a good question. Tertiary markets, we had a gentleman on the podcast, I really forgot his name. Gosh, I can't remember his name now. He is in self-storage, and self-storage is a much more fragmented market than multifamily, and they're chasing yield also, and they're going into secondary and tertiary markets. But remember what I said about exit strategy. If your exit strategy going into a tertiary market, which is a smaller market, is to flip the property in 2 to 3 years, that may be risky because who's buying that property in the back end? You may not be getting the multiple or the appreciation as you would in a primary or secondary market. I mean, we're in tertiary markets. We're in Maryville, Tennessee, which is, a submarket in Knoxville. It's an infill. It's probably 30 or 40,000 people, but it's a great market. Just understand what your strategy is. Going into those secondary and tertiary markets is not a bad idea. You're going to get more cash flow. Expenses are a little bit lower. It may cost less to run that property, but if you're going to find a property management company, make sure that there is one out in a tertiary market. If the tertiary market's a mile away from the city, from any other metro, and there's 20,000 people, you may not find qualified property management unless you, and that's the thing, if you're managing the property yourself, then maybe that's off the table. But when you're going to sell that property, is there somebody going to be buying that property? Or is there demand for that property? And also, when you're going to refi the property, cap rates are going to be a little bit higher because there's more risk in secondary, tertiary markets. So just look at what your business plan, what your exit strategy is on that. Does that make sense, Josh?
Yes. Okay. So
Yeah, that does. Thank you.
How's it going? How you been?
Busy, Gino.
Good.
Real busy. We're finally out here in Texas. We made that move, so just getting adjusted.
How do you like it?
Love it compared to Oregon. That's for darn sure.
Took a while though, but you know what? You know what your why was? You did what I did, man. Just getting out of New York and coming down to Florida. It's a big decision. It's a tough life, but if you can move from Oregon to Texas and make that big move with your family and settle in, that's a really tough transition. Can you imagine? Multifamily is going to be a breeze for you. Once you settle in and you start making these relationships and you start getting clarity on that, it's going to be a breeze for you if you made that move. So congratulations.
Thanks, Gino. Thanks, Josh.
Of course. All right. So we got a question. If you're a beginning investor, would you suggest getting started in multifamily or single family?
Really comes down to your goals. I mean, single family may be comfortable for a lot of people because they've bought their house and all, and there's nothing wrong with single family, but what is your exit? Remember what Stephen Covey says, think with the end in mind. If the end in mind is to get into multifamily, why get into single family to get into multifamily? I mean, I would just say get into multifamily, get into smaller multifamilies. And when you're getting into multifamily, there's so many different ways of getting into it. You can become a limited partner. You can invest in other people's deals to begin with, to get some experience, to see how to run these properties. That's one way of doing it. Getting into a deal smaller, start partnering up with other people, because when you partner with other people, it's an amazing thing. I can almost say with certainty that I wouldn't be here if I hadn't partnered with Jake. I'd probably have a smaller portfolio, maybe 100 or 200 units. I'd be struggling. I wouldn't know how to systemize my business. Partnering is amazing. So for you, just figure out what your goals are, what you want to achieve, what type of business you want to get into. And also, if you're going to get into the single family space, please think of yourself as an entrepreneur when you're getting into real estate. Jake and Gino, we like to say we create multifamily entrepreneurs because that's what you're doing. So if you're going to get into single families, please look at it from that perspective. You are an asset manager. You may be a landlord, but you are an asset manager. The problem with single families, it's going to be hard to scale. You're going to have one here, one there, one there. By the time you have 20 single family homes, you've done 20 transactions, 20 escrows, 20 insurance, 20 insurance contracts, whatever it is, 20 different property taxes you're paying. Just buy a 20 unit, do one deal. That's all it takes. One deal instead of 20. That's the difference. And you have 20 units all in one location. Jake and I, in that first deal, we had 25 units with my brother. He was a pharmaceutical rep driving around. He can go on Fridays and collect the rents. It was all in one location. When you turn a unit, all the units are very similar. There's not 20 different homes with 20 different driveways and 20 different roofs. So for me, really learn the space, learn the multifamily space. And if that's what you want to get into real estate, get into multifamily.
Cody, I want to be cognizant of time. It is 8. How are we doing with that?
Yeah, man. Hey, this is y'all's show, and this is amazing. And I think, it's an honor to have you guys here sharing such great wisdom. So I would say let's keep rolling for a few more minutes.
Sure. And if anyone's got any other questions, I'm an open
Yeah.
book. So
okay. So can you talk about acquisition? Do you guys do any outreach to multifamily owners, or do you focus on building broker relationships and having them send deals to you?
So that's another question with the 3 pillars of real estate. Remember where we were on the market cycle? When we got in, there were deals on LoopNet. You guys know what LoopNet is? No deals on LoopNet anymore, though. But remember, those deals were sitting there and there was no money. Now there's three real ways we're doing it. We're doing direct to seller. On these smaller multifamily deals, we're getting lists and we are calling owners. That is a viable strategy right now. The second one is really having those broker relationships. That's why sometimes it takes a few months. And I think Cody and Nick and Nick Emiluxon, you can attest to it. You need to know the market. You need to learn who the brokers are. You need to start creating those relationships with those brokers. And then all of a sudden, one day they just start sending you deals. You create that relationship. You're not a tire kicker. You're going out, you're understanding the lingo, you're knowing what a cap rate is, and you're creating property tours. You're going on property tours and you're actually meeting these brokers. And the third way is really through vendor relationships. We've gotten deals from property management companies, from our title company, from our community banker, from our inspector, from all different vendors we've gotten them from. But how does that happen? Being in the business and getting yourself out there and closing that first deal. Remember, as the great Jay Scott says, you either have 0 deals or you have multiple deals. I've never met somebody who's just done one deal in a multifamily real estate, because once they get that first deal, that second deal is ultimately going to come because you've created that relationship and you've got that credibility.
Okay, so what are some operational mistakes in multifamily that you have made or seen others make that we can learn from and hopefully avoid ourselves?
I mean, the operational mistakes for us, we call evaluation through operation, not renovation. That's the part of the cycle we're in where we're looking at deals where we want to go in and cut those expenses. Operationally, right now it's difficult to get maintenance, and maintenance techs are very hard to come by. So we've got to pay them more right now. That's what's going on with multifamily. That's a tough aspect of the business right now. That's very difficult. Operationally, I'm just trying to think. For us, when we started out, we didn't have property management software for the first 600 or so units. We were using QuickBooks, and we were also using this crappy Rent Post. Start using property management software. Use Appfolio, use Buildium. I mean, that was the biggest mistake. If you can't manage your properties, you can't measure them, then you can't manage them. That was the biggest mistake that we made. And then once we scaled up and we changed over to Appfolio, everything changed. And the other thing was, please do yourself a favor. Every year, create a budget for your property. Create what the actuals are and create what the budget's going to be and see where they are, and have those monthly reviews with property management companies, because you want to hold them accountable. Because property managers, hey, their job is to, like I said, put butts in seats. They don't care if a ceiling fan costs $180, it costs $72. Maybe the cheaper one does a better job. But if you don't give them guidance and you're not looking at your expenses, you're not being an expense hawk, and you're not underwriting expenses every single year, you get that expense creep. That's what's going to happen. I mean, waste management is a big one. We go in properties, we see waste management there. You're paying 5 times more than what you should for garbage. That's one of the big ones we see. But contract services is big as well. So when you're going in there, please create that budget and, see what happens with the actual and see how far you off, and then continue to pivot and continue to get better with that.
All right. So next question is, you've had tremendous success with the properties you have purchased over time. Have there been any properties that have not panned out? And at what point do you decide to think about exiting, then continuing to stay involved and doubling down?
Mr. Brian R. Farrow gave me one of the best acronyms, ROE, return on effort. And we had a property about a year and a half ago. We exited about a year ago. I mean, the property was a good property. I mean, we made money on it. We had about a 13 IRR on it, but it was just dragging us down. There was so much bandwidth going to this property. We had underestimated the area. The median income wasn't as high as it should have been. It was hard to keep maintenance techs on there. We could have kept the property. We'd still be doing okay with it right now. But at 243 units, we were doing $1.2 million in revenue per month on collections with this property. We took this property off 8 months ago. And guess what? We're at 1,275 with 143 less units. It was that much of a bandwidth issue. So when you see something going on like that, if you can cut bait, as they say, and get rid of a property that's a really big headache, that's what we ended up doing. And it's made our entire portfolio that much stronger. So for us, really be careful of the areas you're going into. I mean, like I said, those higher cap rates, sometimes there's a reason why there's higher caps. We look at that median income. It's an important component for us to see what type of tenant base we're having, because we want to serve tenants that are actually working and can afford to pay rent at the units that we have.
All right, Gino, last 2 questions. So one, as someone who knows construction deeply, what is your suggestion how I should pitch other multifamily investors on how to partner with me so I can get on the GP side?
So if you're going to go, if let's say you're in the market and it's in your backyard, I mean, construction management is huge. Depending on what the partnership wants to do, are they getting into heavy lifts? If they're going to take a property, let's say they're buying a $5 million property and they're doing a $3 million capex, well, there's your pitch right there. You're going to manage that entire budget, that entire job yourself. There's a lot of value in that. If they're not going through that kind of property and they're just buying a momentum play, what kind of value can you bring to them? That's what you need to look at. You need to look at what that partnership is doing with that property. And if you can bring value to them, we're always looking for, for guys and people who can really run those projects. Construction is very challenging right now, but look at what kind of projects they're doing. If they're not doing that kind of project, is there value in it? And if they are, you can bring tremendous value to it, because you can be saving them money. You can be a big component to that property, because if it's a value add property and you're looking to add value by doing that construction, there's a lot of value to that.
All right, final question. How do you educate and train limited partners on current day lower cash on cash returns?
It's funny you should say that. You got to read the book. Anthony Vicino, our coach, just wrote this book on passive investing. It is going live. I think August 11th, we're launching the book and what the great thing about this is, he's written it for passive investors, because honestly, not everyone is made to be an active investor. There are people out there who are high level. They've got their accountants, their lawyers, their realtors who are crushing it. They don't have the bandwidth and the time to do this full time. They need to read and educate and read books like this, like Anthony wrote about passive investing. Passive investing is a great tool. You're limited to the deal itself, the risk itself. You're basically not doing any work. And for the most part, if you're making 8 to 10% of your money without doing anything, isn't that worth it? Remember, I just said the ROE, the return on effort, and you're in an asset class that's amazing. So for you, for anyone out there trying to educate limited partners, the first conversation you need to have with them is, what type of risk tolerance are you looking for? What type of market are you in? And what are your goals as an investor? That's what you need to know. You need to know what they're looking for. If you can find out what they're looking for, if there's, as Josh likes to say, finding impact together, that same side selling, that's when there's a marriage. That's when you guys can work together. As us, when we're raising money and we want to work with investors, we have a long-term horizon. If an investor wants money back in 24 months, they're not our fit. We want to hold these deals long-term. That's what our strategy is. We're not here to flip a property in 3 years. So that investor has to get educated and say, hey, the Jake and Gino model may not be right for you. But once we explain to them, hey, that's where you make the wealth. Sam Freshman is an amazing syndicator. He wrote a book and he's been doing it for 50 years. His 2 biggest mistakes, he didn't buy enough and he sold too soon. So if a guy in his 80s is telling me that, maybe I should take that advice and say, you know what? I may not be able to raise all the money in the world. I may not find a ton of investors, but I want to find the right investors who are looking at my model and saying, this model that Jake and Gino are performing, we're doing great. And if you're not doing that model, that's fine. That's great. Just understand what you're doing and explain to them what your model is. And hopefully they like the model. And if they don't, there's so many other people out there that have money that want to invest with you.
Boom. All right, guys, we want to say thank you for allowing us to be on here. Hopefully this added a tremendous amount of value. And if there's ever any way our team can help, please absolutely reach out. And you guys are in a great group here with the Multifamily and More guys, surrounded by some really awesome people.
Cody, the last thing I'll say is October 23rd and 24th, we're having MM4 in Orlando. If anybody wants tickets or wants more information, you can either email me, gino@jakeandgino.com. You can go to the website. I mean, we still have early bird on there. I think their tickets are $197. There's going to be 650 investors there. There's going to be a bunch of Jake and Gino students there. It's 2 days. It's the financial vacation for smart people, we're calling it. It's in Orlando, end of the month, end of October. The weather's beautiful. I'm going to Disney the next 2 days. So for us, we haven't done an event this big, and since 2019, last year we couldn't do one. This is going to be a lot of fun. We're going to have some amazing speakers. It's 2 days of buy right, manage right, finance right, and this is where you find deals. This is where you make relationships, and this is where you raise the capital.
Man, it's going to be so awesome. I know I can't wait. I know there's several people here that's on the call tonight that's going to be there, and it's just going to be absolutely on fire. So I see, Josh, you just posted a link down there to the MM4. But before you guys take off, would you mind telling the audience, if they haven't got connected with you guys before, how can they get a direct line to you guys?
Oh, just go to jakeandgino.com. I mean, if you want to email me, I've got multiple books. I mean, if you want to email me Creative Cash, I can send you a PDF copy, gino@jakeandgino.com. I can send you a PDF copy of Wheelbarrow Profits or Creative Cash, because I think, like I said, the first thing to do is just to start educating yourself and reading about the space. Some people may say this is not for me. I think the vast majority will say, this is for me. How do I get into it? What can I do in this space? How can I make impact in this space? So first step is to read books, hit me up on my email. And the other thing is just go to jakeandgino.com and start listening to the podcast. You want to add anything to that?
No, love that. Reach out to Gino. The G-Dad's the man.
Yeah.
That's it. Gino, you're always absolutely amazing, man. Just a ton of wisdom. We really enjoy being a part of your mentorship and tutelage. And Josh, the absolute coolest community director out there, man. Just networking king. So love it. Before you guys take off, I'd love to invite some of our co-hosts from Dallas, Austin, and Houston here if they want to jump on and just send any farewells before you guys take off.
Absolutely.
Yeah, thanks, guys. This has been great. Thanks for taking the time. You guys are always adding tons of value. Thanks, Jake and Josh. Super, super helpful.
Thanks, Nick.
Yeah.
You know, you have to make me a pizza so I can compare and contrast.
I hung up my apron, my friend. I have PTSD when I think about kitchens. That's really bad. I can't go into a restaurant and enjoy going to the restaurant because every time I look in now, I look and see if they have systems. I look to see how they talk. I look to see how they it's weird. It's just weird. I can't enjoy going to a restaurant anymore.
I have the same problem. Don't worry.
Oh, it's bad. It's really bad.
You're working towards a new tagline there, Gino. You got chef turned real estate investor turned opera singer. I can't wait, man. That's coming full circle.
Oh yeah.
Awesome, man. Well, guys, thank y'all so much for your time, Josh and Gino, man. You guys have been absolutely incredible, man. Ton of value here. Everybody, if you guys want to stick around, we're going to go into some breakout rooms, get some networking in. That's where have some fun here. But if you got to jump off, don't worry. We're going to send this link out. And, just absolutely, again, thank y'all so much, man. This has been absolutely incredible.
Thanks, guys. Take care, everybody.
Awesome. All right, guys. Cool. Well, we're going to go ahead and break out into some breakout rooms. Nick, you cool with that?
Let's do it.
My Dallas guys, Austin, we good? Y'all want to do some breakout rooms, do some networking here for a little bit? All right, let's see. We've got about 30 people left on here. So let's see what we do. How about we do 6 breakout rooms? All right, here we go, guys.